Hi, I'm Daniel Dickson with freeaccountingschool.com, and today we're going to talk about the following questions. How does double entry accounting work? What is an account? Then we're going to go over a real-life example of how double entry accounting works, what are debits and credits, and why go through all the hassle of using double entry accounting. Okay, so let's get started. How does double entry accounting work? Well, for every accounting transaction that you have in your business, so every time you buy something or sell something or pay someone, anytime money exchanges hands, you're going to make at least 2 entries into 2 different accounts. Now, what is an account? Well, back before computers, an account was just a piece of paper with a big T written on it, which separated the paper into different sections. And nowadays, an account is usually an electronic file that you have as part of an accounting software program. But whether you're going to do accounting in a computer program or on paper, the concept is the same. And most accounting teachers, including myself, are going to teach you how to do accounting on paper first. And then once you have that concept down, you can learn how to use accounting software programs. Okay, and so for businesses who don't use computers for double entry accounting, they usually use an accounting notebook. And this is just an a paper notebook where they have different accounts drawn on different pieces of paper. So let's assume that this is a piece of paper in your accounting notebook. The name of the account would be written up here at the top of the T, and here on the left-hand side and on the right-hand side is where you're going to write down the transaction information for the different transactions that happen. Sometimes you'll write it on the left, sometimes you'll write it on the right, depending on the transaction. We'll show you more about that later. Also, you should note that you're going to have a beginning balance either at the top left or at the top right, which is the balance from prior periods, depending on the account. Some accounts won't even have a beginning balance. It depends. You'll learn more about beginning balances in future lessons. Also, at the end of the accounting period, when you're done using this particular account in this particular notebook, you're going to have a summary of your transactions, either the bottom left or the bottom right, and that's what's called your ending balances. So we're going to learn more about ending balances in later lessons as well. Okay, so let's do an example of how double entry accounting actually works. Okay, let's pretend you live in the downtown of the city and you own a food stand and you sell different food items out of this food stand, and you sell ice cream and other desserts to the people who live and work in the buildings nearby. Okay, and let's assume you do all of your accounting on paper in an accounting notebook. Okay, well, let's assume this morning you wake up and you look at your food stand before business starts, and you see that you're all out of ice cream bars, and you know it's going to be a hot day, so you want to have these ice cream bars available for your customers. So let's also assume that you keep all the cash for your business in a metal strong box that you carry around with you. Okay, so this morning you go over to the food warehouse store and you buy $50 worth of ice cream bars. So it's 50 ice cream bars for $50, and you pay for it in cash out of your metal strong box. Okay, well, that's a pretty simple accounting transaction right there. So how would you record that using double entry accounting? Well, first what you're going to do is go to an account called Cash in Strongbox. And this is an account where you record the cash that goes in and out of your cash strongbox. Makes sense. And unless this was you're a brand new business, you would have prior entries in this account for when money went in and out of the strongbox in this particular accounting period. But for simplicity's sake, we're just going to pretend that they're already in there, and we're not going to write them in so it's not confusing while you learn how to do this. Okay, so double entry accounting rules say that for this type of account, this is called an asset account. An asset account assets are things that you own in your business, and cash is definitely an asset. So for for accounts that fall in the asset category, to show a decrease in that asset, you do an entry on the right hand side, and we want to show that we now have $50 less in cash. So you would go and write $50 on the right side of this T in this account. Okay, also, if this were a real accounting notebook, here in front of the 50 we would write the date, and then over to the right of here, we might write a little memo saying where we spent this $50. So we might write that if today was July 1st, we'd write July 1st and the year, and then over here we'd write a little memo saying maybe food warehouse, so we know that we spent the $50 in the food warehouse. Okay, so the next thing you need to know before we move on is that what we just did is called making a journal entry. Okay, so now that we have the $50 entered into the cash and strongbox account, we're going to go over to another account that's also an asset type of account called inventory. Now, what is inventory? Inventory is something that you either buy or make in your business that you're going to sell to somebody else. And these ice cream bars definitely qualify for inventory. And for an asset type of account like inventory, to show that we have an increase in this asset, we're going to make an entry on the left side of the T. So that's what we're going to do over here. We're going to write $50 because now we have ice cream bars that are worth $50. And remember, in an actual accounting notebook, before this $50, you would write the date. So if it were July 1st, you would write July 1st. And after here, you'd probably write a little memo. For instance, you'd probably just say ice cream bars, so you know that it's $50 in ice cream bars that you bought. Okay, so that was your very first double entry accounting set of journal entries. Congratulations. Now can you see why it's called double entry accounting? Because you make entries into at least 2 different accounts. And you should know that in certain types of transactions, you might make entries into 4 or even 5 different accounts, depending on the transaction. But don't worry about those. We'll learn more about those in future lessons. In future lessons, I'll also teach you that there are many different types of accounts. There's, like we just did in our last example, asset types of accounts that show all the different cash and equipment and inventory you have. There are accounts that show the different kinds of debt that you have, or you owe people money. There are accounts that show why you got money into your business or why money left your business. And there are other accounts besides that. And so we'll learn all about those in future lessons. Okay, so the next thing I want to teach you about double entry accounting is that the dollar value of the entries you make on the left always need to equal the dollar value of the entries you make on the right. So let's look at our last example. You can see that the dollar value 50 was on the right of this T and 50 on the left side of this T account. So the dollar value of all the entries made on the right side equal the dollar value of all the entries made on the left side. That means our journal entries were in balance, and that's what always has to happen for every transaction. Okay, so you should know for other transactions where you might have 3, 4, or 5 different accounts, it could equal, you could have your journal entries be in balance in a myriad of different ways. Here's an example where you have $25 in account number 1 on the right side, $50 in account number 2 on the left side, and $25 on the right side in account number 3. So 25 plus 25 on the right equals 50, and 50 on the left. So all the entries on the left or on the right equal all the entries, the dollar value of all the entries on the left. And so this would still be in balance. Okay, so the next thing I want to teach you is that when you make an entry on the left of a T account, it's called a debit. And when you make an entry on the right, it's called a credit. Let's look at our example again. When we made an entry to the cash and strongbox account, this was a credit because it was on the right side. When we made an entry over here to inventory, well, that is a debit because it was made on the left side. So debit means left, credit means right. Now, why do we use the words debit and credit? Why don't we just say that this was a right-sided entry and this was a left-sided entry? Well, it goes back to the Latin words they originally used when they invented double entry accounting, and it was based off of these kind of Latin roots of these words, and it became tradition, and the terms just stuck. And if you're going to do accounting, you just got to remember debit on the left, credit on the right. Okay, so that's it for today. If you like my videos, please do me a favor and go over to YouTube and give me a a thumbs up for my video, or maybe leave a comment. If you really like my videos, maybe you can subscribe to my YouTube channel. And if you want to check out more of my accounting videos, please go to freeaccountingschool.com.